Thank you for joining us for the equity market commentary for the month of July, Yvonne. For the first question, markets breathed a sigh of relief after Europe reached an agreement to ease the conditions to recapitalize troubled banks in Eurozone. Germany and other Eurozone countries have softened their bailout stance. What is your view on these measures can do in containing the Europe debt crisis?
Going into the third quarter of the year, investors need to pay attention to developments on several fronts. The first is political compromise. The recent European Union agreements to relax the restriction on loans to Euro area banks and on the ESM fund represents a meaningful step forward, as they suggest that Germany is willing to make some compromise in an effort to stem this crisis. It is obvious that the size of the crisis has passed the point where any single country can provide sufficient funds. The size of the German economy is merely 2.6 trillion euro. This is actually much smaller than the combined outstanding debt of Italy and Spain, which amounts to nearly 2.8 trillion euro. Hence, it is neither economically feasible nor politically possible for Germany to carry an ever-increasing financial burden in order to bail out any troubled nations. The possible options include ECB monetization, Eurobond issuance, or turning ESM into a bank. All of these choices are possible and could become much needed game changer to put an end to the financial crisis. However, none will be adopted easily without any financial turmoil or bloodshed in the marketplace. The second development is monetary reflation. The ECB may have to reflate more aggressively given that German manufacturing has slumped. French consumer spending has also dropped, and inflation has fallen sharply across the Eurozone. The third development is economic performance. Investors must separate financial markets from the real economy. Although stocks, bonds, and European currency could rally on new policy initiative, the Eurozone economy will go through a lengthy period of painful adjustment. The bottom line is that we do not think there is a quick solution here, but nevertheless, European politicians are making good and some slow progress, evidenced by the recent agreements reached at the recent EU summit. Any sign of political compromise is a positive for market sentiment. We expect Eurozone crisis will flare up from time to time.
Question 2. Despite a bright spot in the Eurozone, economic data from the US and China are disappointing. What is your assessment of the outlook for the two largest economies in the world?
The recent economy data continues to confirm slowing growth globally. The US Manufacturing Purchasing Manager Index (PMI) dropped to 49.7 in June, below the 50 threshold level, from 53.5 in May. The US ISM New Orders Index fell from 60.1 in May to 47.8 in June, the lowest reading since April 2009. US employment numbers have also been disappointing lately. Unemployment rate has been stubbornly high at 8.2%. Non-farm payroll only increased by 80,000 in June, and the monthly rise averaged at 75,000 in second quarter, well below 260,000 to 275,000 level achieved in January-February this year. The slow job market will impact the consumer confidence in US, and this is very important as consumption accounts for 71% of US GDP. We do not expect any fiscal policy ahead of the November elections. So, US will have to rely on monetary policy. Thus, the US 10-year Treasury bond yield will continue to be low for some time. As for China, the economic growth has been slowing down as well. The first quarter GDP increased by 8.1%, down from 8.9% in fourth quarter last year. But China may suffer another quarter of slower than expected growth in the second quarter. China has been hit by a drop in demand in the key markets including US and Europe. And at the same time, the domestic demand has also seen signs of slowing down as well. A good indicator is the retail sales number. The retail sales used to grow at 17 to 18% year on year, late last year. This has slowed down to around 14% lately. To be exact, the retail sales only grew by 13.8% year on year in May. Despite all the signs pointing to a slowdown in China's economy, we believe the authorities have enough policy ammunition to engineer for a soft landing. China has the capacity to stimulate the economy given its huge current account surplus and budget position, although the magnitude is unlikely to match the stimulus in 2009. China policymakers have already taken some measures to loosen its monetary policy. The People's Bank of China, PBOC, has cut the reserve ratio requirement twice this year, from 21% all the way to 20%, 50 basis point cut each time. And this has helped to increase the liquidity in the banking system and help to boost lending. And lately, PBOC has also surprised the market by cutting the interest rate, and the one-year deposit rate has been cut by 25 basis points to 3%, while the one-year lending rate has been cut by 31 basis points to 6%.
Question 3. On the local front, we've seen M&A activities are taking place and a number of IPOs in the pipeline. What do this mean for the local equity market?
M&A and IPO have been the catalyst for the Malaysian equity market lately, which partly explain that the local market is holding up much better than the regional markets thus far. The recent IPOs such as Felda Global Ventures and Integrated Healthcare Holding have been very successful and managed to attract a lot of foreign interest. Indeed, Malaysia has become one of the top IPO destinations in 2012, with Felda Global Ventures IPO being the year's second largest IPO globally after Facebook. And we believe M&A news and IPOs in the pipeline, especially the big IPOs, will continue to attract both local and foreign interest.
Question 4. The government has implemented measures to improve our local investment climate. How effective are these measures, and what are the potential impacts on the local economy?
There has been a concerted drive to improve the key facets of the country's investment climate through the government and the Economic Transformation Plan. The programs such as the Strategic Reform Initiative should lead to improved competition standards and human capital development. The impact has already been noticeable with market increase in the FDI number. The FDI was up by 12.3% in 2011, and the private investment was up by 19.4% last year. So according to the latest figures released by Pemandu, Malaysia is experiencing its highest FDI and private investment figure in 10 years. And FDI reached 32.9 billion last year, private investment reached a high of 94 billion last year. So the result seems to be slowing emerging. In the FDI Confidence Index, the Malaysia ranking has improved from 21st in 2010 to 10 in 2012. Malaysia has also been steadily improving in the World Bank Ease of Doing Business report for 2012, the ranking up from 23 in 2011 to 18 in 2012. It is also important to note that the gross national income per capita has improved from $6,000 in 2009 to $9,005 as at the end of last year.
Question 5. What can the fund managers do to protect the investors at this point of time?
When markets are volatile and sentiment is fragile, there may be little to protect against falling equity prices. Given such a backdrop, an equity fund manager may be able to offer some protection by investing in companies with strong balance sheet and sustainable cash flow, high dividend yield stocks, companies with decent business model, strong earnings outlook, and yet trading at attractive valuations due to the falling prices. The fund manager may also want to hold a bit more cash to accumulate good fundamental stocks during market weakness.
Well, Thank you very much for sharing your insights today. It's very lovely to have you here, Yvonne.
Thank you.